the monthly chart rather of Centrica, and one can see that the last low on the stock near this area was 128 back in 2003, when we were all relatively young and optimistic. And the question now obviously is whether this stock is going to fall further. RSI here at 25 out of 100, so that's the lowest it's been, looks like ever, which is interesting. We'll see what Russell has to say about that. Going the other way, Just Eat. I read in the front of City AM that hotbed of financial information that Just Eat is threatening to go back to the FTSE 100 or enter the FTSE 100. As company, the food delivery service, which or food delivery app, which I think a lot of people, hedge funds and others, just basically thought it was a stonking short from the start. And as you can see, it's been absolutely the opposite. Shares have just rallied all the way. And obviously, any company which is threatening to re-enter the FTSE 100, it gets a boost anyway, as the tracker funds get involved in the shares there. So that's also a situation to keep an eye on. As far as the markets today are concerned, just a quick roundup there, a bit of a risk-on situation. DAX coming back nearly 30 points after a miserable week. FTSE sort of outperformed the DAX, and obviously the Americans are waking up after Turkey overload. Yesterday we have the irksome Black Friday shopping, retailing bonanza. Surprising that the Americans are not into Boxing Day like we're into Black Friday, but that's obviously one of life's great mysteries. My favorite market, Bitcoin, edging up again. Been a little range either side of 8,000, so 8,250, so threatening to break back to the upside. The big news, I think, of this week on the crypto area was Ether, which just rocketed. I think it was around 360 at the beginning of the week, now 405, and it's been a bit higher. And I think the final thing to maybe to keep an eye out on is crude oil edging towards that $60 zone again. But I hope that Mr. Russell Jones is waiting in the wings, stock trader extraordinaire, especially yesterday, where he delivered the legendary long majestic wine short mother care spread. A retail specialist, obviously, Russell. So we'll see what he has to say today. Good morning, Russell.
Good morning, Zach. Good morning. Yeah, that was a good day yesterday in terms of some of the investments I took. In terms of Majestic, it did go up to 428 at one stage. I made a decision in the afternoon. You know, it's mentioned in today's FT and it's by Lombard. What I stated yesterday about the franchise arrangement, kind of incentivization, not official franchise, but giving the managers an incentive to earn more money, is proven to be very successful. And obviously they've now created increased business by repeat business. The shares closed up 11% at 425.50. Now, I'm talking a little bit about actual trading today because, as I said to yourself, now I wouldn't have known much about this stock, if I'm honest with you, if I wasn't for the fact that I started supporting this webinar. And that means that I look at the interims and the finals of some companies, which really isn't in my core portfolio. I've got a core holding portfolio, which we haven't discussed, but in effect, I've looked at these as trading opportunities. And it was quite clear that Majestic was a trading opportunity, and that's why I stated it. Now, I made a call then yesterday based on Centrica more than anything. As Majestic continued to rise throughout the day, it hovered in the morning around between 6 and 9%. And when they went into double digit, I thought I'm going to take some profit. The choice was, and this is where we are when we trade, is do I hold on for the 2p dividend, because it goes ex-dividend on the 30th of November, but all in likelihood, whenever stocks go ex-dividend, they drop by that amount the same day, or sell out. Well, I sold out, and within 48 hours, well, less than 48 hours of buying and selling, I made a nice little 18 grand. Now, 18 grand is a nice little profit to make, because I believe that it had such a good run yesterday, though it could go further ahead. You don't have to have many winners. People tend to forget when you're trading, the majority of the stakes you take initially should be of a size you can manage to go the wrong way, because you'll make more mistakes than successes. But as long as obviously the successes you do have, you then capitalize on by either adding to it or increasing. I made the decision, I came out. But on Centrica, it's interesting, Centrica. There's a lot of, when Zach was talking about it yesterday morning, or the massive loss of the customers, which has been highlighted. I bought Centrica, only a relatively short period ago when it was tipped at 235. And I ended up coming out of that position. I was losing 30k because it just seemed to keep on falling and falling, which was really cheesing me off. Now, obviously, the loss of these 823,000 customers, as emphasised in the Lex column today. So whereas you get virtually all the papers talking about this headline news, the noise around these customers in terms of the profitability of the company, it's not really going to impact it, because these are the low margin customers, which is what they state. I don't know how accurate it is, but obviously they state that their profits are still going to be cut from 15p a share to 12.5, but that's primarily coming out of the US business operation, where the profit, which was earned last year, 220 million, or that's what they were expecting a minimum this year, is going to drop to 80 million. So asking yourself a question is this bottom fishing now? Should we be bottom fishing this share? Because Centrica has dropped by over 50% since the CEO, Mr. Connor's taken over. Now, they are, out of the big six, Centrica has 74% of its business in terms of the consumers they rely on. It's not as much as one of the competitors, but they are relying on these tariffs. Now, they've already put in their proposal for exiting variable tariff for new customers. I thought when they announced last year in the news that, I'm not with Centrica, but that they were putting up electricity prices and they didn't give a damn, I thought that was an absolute disgrace and anyone should have been switching, which obviously there was a lot of prominence. But going back to the share price today, Centrica is off by 0.7% this morning, 137. I made a call. I was talking to a friend of mine. Some people might know him, Ronnie Chopra, yesterday. Ronnie bought in at about 140. I thought it would have dropped further, and it did. I had a target of 135. Did my initial purchase at 135. Then I bought some more under 135. In the end, I added at 137 and 138. But I built up quite a large position. I've got 770k in there now. And the reason I've done that is because I can't see it going much lower. It's still paying a dividend of 9%. Now, there is talk that they may cancel the dividend. In terms of cancel, reduce it. I can't see that happening because it will be too damaging.
Sorry, are you sure? Are you sure, Russell?
I'm not sure. But
the first thing I would do, I mean, especially if I was a CEO there, I would just say, I'm already looking rather embarrassed. Just say, I mean, it can't be more unpopular anyway. It's been a disaster. Kitchen sinking the situation by halving the dividend would be in order, and it would make him look, tough and prepared to do what it takes. So the first thing I would do, we'll see what happens. But,
even if he halved the dividend, he's still paying 4.5%. To that current valuation, dividend is 9%. So if you could pick up a 4.5% dividend, which is higher than the FTSE average, you'd be chuffed. But obviously, we're talking about, is it a buy and hold and you're waiting for the dividend, or is it a short-term buy and a recovery? I personally taken the latter stance.
Yeah.
I do agree with you. So I've gone in there thinking that if it goes much lower, is it going to be bought?
The only thing is, 128 is that 2003 low, and so probably and hopefully it will be trading between that zone and say somewhere in the 130s as the low here. So the RSI is now 19 on the daily chart.
Well,
anything in the teens is literally, I think Petrofac, the lowest it went to on that blowout was 13. So anything in the teens, especially the low teens, is normally a decent bottom fishing opportunity. But obviously, it's just whether there is that. I think the dividend thing is the issue. I suppose they would have done that already, wouldn't they?
Well, I'll quote you it on Lex today. He says that produces a yield of more than 7%. The actual yield is 8.98%. reflecting concerns about the sustainability of the payout. To stabilise the share price and restore faith in the dividend, Mr. Khan needs to get his US flank under control. Well, he's screwed up on US. He sounds like he's screwed up everywhere, but if UK home is truly in better shape than thought, Centrica should rise out of the trenches in the months ahead, and that's the way I see it. Now, I see that Centrica cannot go much lower than what it currently is, because if it does, it's going to be bought by a predator, or the government will try to block it. It's small change now. It's under 8 billion. A Chinese company will come in and snatch that. It's nothing. But the problem is they'll get so much grief. Any foreign buyer will get so much grief just for being foreign in the current app. But I don't care about the foreign buyer having grief. Going to push the share price up anyway. So you're in a win-win situation. Someone comes in, makes an offer, it goes up. I can't see it staying below 140 today. I'd be amazed. It's now currently flat for the day at 138. So, for myself personally, every penny it goes up is 6.5k a point.
The only thing with this is after being quiet on Carillion, I think I'm quite happy to come up with the devil's advocate scenario here. I think that if there was going to be a foreign buyer, the foreign buyer would have come in ages ago. There's clearly something here which stops a foreign buyer buying. I.e., this is one of our national treasures with British gas, etc., and all the political uncertainty as well. If the Marxists come in, and so basically we've got there is an issue here, and in a way, it would be better if the company split itself up before anybody took it over, rather than any other strategy. I think that would be the real thing. The other point on Lex is that Lex is a very conventional way of looking at the market and stocks, and is normally backward looking and just reactive rather than proactive. I'd rather trust your judgment on something rather than Lex. But
Zach, if you just look at you from a technical perspective, you've seen it's fallen and continually going down. It's been mismanaged. They couldn't have done a worse deal in terms of the public perception. You've got all the switching organisations saying switch, your gas and electrics. The government are going after the big six. They've come in with a proposal which may not be that revolutionary, but it's going to be better than anything they had previously. They're going to have to do something on a public perspective to actually gain some confidence back. As soon as this initial furore of all the news, that RSI is not going to stay under 20. That RSI, even if it went up to 45 or 50, Zach, the share price is going to go back up. So I can't see the 138 price staying. I agree with you in terms of potentially any bid should have occurred previously before, and the dividend is not totally guaranteed. However, at the moment, even if they halved it, it's still 5%. But for getting the dividend as a trading stock or buy and hold, bottom fishing, I think it's worth a consideration. There's not many classic buy and holds. This is not a company that's going to go bust. It's not a Carillion. It's not going to be a rights issue. It's nothing like that. So okay. A solid performer in terms of profitability with just under 8 billion market value now. There's no way, we all have to heat our homes, etc. There's no way that this company can continue to languish around these levels now.
All right, I want to move on from Centrica, so we'll see what happens there. William Hill, which I don't know if I've talked about it here before, but it was just a few days ago. We had that gap through the 200-day moving average, and this morning William Hill confirmed it was in talks on an Australian merger. A bit disappointing was probably the market was looking, as you can see from that spike there, the market was looking for something a bit more juicy, but at least the charting side there did work reasonably well. What other stocks are you looking at today, Russell?
Well, the other thing I want to just make a comment on is obviously when you're talking about stocks, a stock I mentioned last week initially, which was Go Compare, bid in from Zoopla at 110p. It hit that 110p 2 days ago. And I was getting frustrated because I was up in that stock a couple of K, 4K. And I made a call again yesterday afternoon, and this shows why. Go Compare was flat almost for the day, down 1p. I sold out of my position around 3 o'clock, and it's incredible how a stock with low liquidity, when it didn't have a massive amount in there, I did have a 6-figure sum, but I dropped the stock, I think, myself on the market. It ended up 7.1% down. I ended up with about £5 profit, and I put that into Centrica because I thought I'd play it because I couldn't be bothered to wait on the Sky bid. So going back to trading philosophy, sometimes, you know, I'm no way as comprehensive as the likes of Vector Vest and technicalities and all that, but on the first show we did, which was back Monday of last week, some of the stocks which are being mentioned just don't have any liquidity. So you can't buy and sell them. So even a small player relatively like myself, who sold out of my position yesterday, I've sold out 90% of it. I got 107.5 at a profit. I adjusted the market down. So you need to be mindful of this when you're buying and selling stocks of a low liquidity, which obviously the market makers won't allow you to obviously keep the price then once you make a few purchases or sales. Okay, going into, there was an article, interesting article today in the Daily Mail from the Argos CEO pleading insanity, basically, that they didn't do anything in the budget around business rates. I think that's just a sign of the times, and it shows how my fears of the retail sector will continue. In terms of results today, very, very quiet day. You've got one full result and one interim. The full results is a company I've never heard of before, but I did the research on it this morning. A company called Future, ticker code FUTR. It's up 187.96% for the year. Market capitalization of 174 million with a forward P of 128, i.e. it's one of the high-rated forward growth stocks. A global specialist in media platform, as it's described that, publishing of special interest consumer magazines, etc. Their results came out. They've only got one broker really covering it, which is Numis. They were up 9.25% yesterday. Where are they today? They're up 1.1% today at 388.25. The EBITA increased by 112%. Adjusted profit was up by 218% to 8.9 million. Earnings per share were up 144% to 23.2. I wouldn't have known anything about this company. I think it's worth looking at if you like small companies with a long-term potential growth. They were founded in 1999. They got 449 employees with an increase of revenue of 43%. I think it's worth looking at. They got 53 million active monthly visitors. And it's, when you look at the website, I've looked at the website this morning, it is dedicated towards a younger generation than myself, although I'm only 54, but it's more for youngsters, and that's the future. So one to look at. But again, the volumes in this company on trading, it's going to be one that's obviously if you dip your toe in, you might get a great return, but it's not something which you can day trade that much because you're not going to have the fluidity of the market. Any comments on that one, Zach?
Well, the chart there is a classic. I mean, I suppose it could be a Vector Vest stock actually, because it's a sort of chart that you tend to see David Paul come up with. But you've got the gaps there through the 50-day moving average, sideways consolidation, old support coming in above former resistance. It just looks like a very, very bullish situation. Runaway move to the upside, and with the fundamentals backing it as well. If there were any chance just to get in at a good price, I think from a technical perspective, one would probably go for it. The other news today was the death of the executive chairman of Provident Financial, which has hit the shares a little bit. Yeah, I believe it's a she. She was only 53. So basically, shares down a bit, but just showing us, it's just like bad news hitting that company. Just on an
I can talk about Provident Financial because it's one of my holdings, and the reason it's a bottom fisher again, and I do believe, although I've mentioned it previously before, I got quite a sizable position in this. I've missed that news. Obviously, they're 8.96 this morning, down 13 at 1.4%. They tend to be a bit of a swing share. They can go anything down to about 8.60 in the morning, not that often these days, and go back up to about 9.50. When they obviously went from £17 down down to 452, only briefly. People say 452 is more like £6 it was stabilising at. Some people got in and made some money out of it. Now, the reality on this company, I see this as a great buy. This is a fantastic recovery stock. It's one of my holdings, and I see in March, I reckon that March, May, 12, 14 pounds here. And it's not one of these which is a day trade stock unless you want to be ambitious, although there is lots of options to do volume trading on this as it moves throughout the day. But the fact of it is the business is split up into 4 areas. The most profitable part of the business is the Vanquish credit card. And the Vanquish credit card, which probably on an individual standalone basis should be valued probably the equivalent of the company now. But it's obviously under
is there a good APR on that?
Sorry?
Is there a good APR rate on that?
The APR rate's about 39%, I believe.
Very reasonable.
So, yeah, but you've got to bear in mind, I agree with the kind of comment you made, but you know, I've said this previously before, there's 10 million people in the UK which for 3 or 4 times a year they run out of money completely, and they can't go to the normal lenders. These people have to finance Christmas for the kids. It could be single mums, it could be people living on their own, whatever, disabled, etc. Some of these people.
Well, yeah, but I have to say, I think this is. I mean, just on a moral standpoint, I think anything over 20% is just outrageous. I think the government, if the base rate is 0.5%, if there's plenty for companies to make out of the poorer people in society with a 20% APR. I think that's, you know, there should be a cap on it.
I'm going to have to disagree with you to an extent, because the default rate on credit with these companies is about 29%. So if you knew that you're going to loan to someone who can't get out of a wheelchair potentially in the house, who's an alcoholic, and sometimes they do that in a circumstance, there's going to be a default rate. The individual lenders, which do door-to-door lending, is different to the credit card. Obviously, there's 4 parts to the operation. You've got a small fixed loan situation, you've got a larger loan, you've got the credit card, which is high, under an investigation by the FSA, because they did an automatic reminder if someone missed payments. Now, that's been taken away, but they still had 13% growth in the last quarter. Now, when the trading update comes through, you're going to find that the collections from the door-to-door lending position will improve. It did improve gradually in the last period. Normally, they have a success of around 90%. But as that does improve, this stock will recover. Now, that trading on the door-to-door lending normally makes 120 million profit a year from the total profits, just over 300. But they've stopped the dividend. And in reality, although that part of the business is going to make an £80 million loss, the overall business will still make a profit this year. Now, the fine, which is going to come in for the credit card, that one-off fine, it's not going to be as bad as PPI, will be between 200 and 300 million. They have sufficient cash on their books to pay that off. So this company, which was trading at 31 quid not so long ago, although I had the dramatic fall, I see this as a massive bounce back. Now, I've said it before, but the 2 companies, because the main problem which occurred was their door-to-door lending operation. They tried to change from having fixed-term contract, full-time, basically part-time self-employed employees to go to full-timers, and it backfired on them. So Moore's Club, a non-standard financial, and from a point of interest on non-standard financial, it's run by the previous chairman of the organisation, and their profits are growing as well. They've picked up over 400 consultants each, which obviously means the door-to-door lending is going to increase. But based on Providence write-off of the door-to-door lending and predictions, credit card sorts itself out, this company's going to bounce. That's my opinion. Sorry about that, just ad lib.
Okay, all right. Well, is that your lot today, Russell?
Got one very brief one. Sorry for, and it will be very brief. The only other thing that came up was the interims on Fuller's Breweries.
Okay.
I don't know much about the company except for they make the Pride beer. They basically have come out with 4% increase in profits, earnings per share has gone up by 5%, revenue up by 6%, dividend up by 4%, market cap of 312. Interesting part of the statement. although they go into tenanted inns, and that's the way they're moving into to obviously get a different revenue stream. They've really criticised in their statement that the rise in business rates is 26% for the brewery sector. So again, a stab at Hammond, who didn't do anything for them like the retailers yesterday. So that's it, over and out.
No, I think that's a scandal. The business rates situation is an absolute scandal. And for Hammond not to do anything or even acknowledge the problem, they're just taking in the money at the worst time in the cycle is outrageous, really. So I think it's a shame that there's no mechanism for complaint by these companies. I mean, I'm not quite sure what the organisation would be, but it's absolute carnage in the high street, isn't it?
Well, the problem is, especially in London, and if you think about it, you know, when you talk rent and rates, and this is a critical problem. For Marks and Spencer's to put out of Oxford Street in London, which Archie Norman has decided to do, which is their flagship store, says it all. Archie Norman, obviously, as we know from his Asda days, and then obviously going into Parliament, etc., ITV, you know, he's a shrewd operator. You know, and for him to make that decision, and when next are renegotiating on their rents, and now if they're not getting them, they're prepared to pull out as well, it shows that the strong bedfellows of, you know, retail in the UK are even making decisions to walk. That decision has been literally lost on people. To walk away from Oxford Street in London is a massive statement from Marks and Spencer's, massive. So when you see pubs closing every day and smaller retailers struggling on the high street, and as you walk down certain high streets, I'm sure you're common with, and there's so many empty shops, or all you've got left is charity shops and estate agents, it's just something that's going to change anyway, but the speed of change is what needs to be slowed down. And, you know, that's...
I think it's madness, isn't it, though? It seems to be absolute madness. Whoever devised the process...
Well, as I said to you yesterday, I think, or the day before, 2.7 million people are employed in retail. Now, it may be, you know, someone might say, well, everyone used to make cotton in the mills. Yeah, things will change, but the speed of change needs to be slowed down before we've got the alternative to give them. If they were going to say everyone who's a youngster is going to be trained to be a builder or plumber or whatever, it's a different scenario, but everyone goes to do a rubbish degree in college these days and come out with a massive debt. So in effect, all we're doing is delaying that problem. But business rates, huge problem. As we speak, Providence up to 904, and so it's only down 4p. But I still see that as it's a launching hold for me. Before I let you go, Centrica, what we got with Centrica today, Zach, in terms of price, it's down to 0.9. Okay, thank you very much for your time.
Thank you very much, Russell. Have a great weekend.
Thank you.
I hope Simon is there. Are you there, Simon?
Yes, Zach, sorry. I'm bringing in John Adamson from ShareTalk.com. We're looking at SDX energy today. And John, you should be live with us.
Good morning, Simon. Good morning, Zach.
Good morning, John. How are you?
I'm not too bad. It's Friday.
Black Friday.
Indeed.
Good to have you here.
Two. Thank you very much. Yep. So SDX Energy, Canadian oil and gas play. I call them Canadian. They're actually headquartered in London now, but it essentially came over from TSX last year. IPO'd around 18 pence, if I remember rightly. So reached dizzy heights of around 70 pence sort of April, May this year. And since then they've acquired Circle Oil, which is a Moroccan asset, but the original assets are based in Egypt. So SDX have got news out this morning, which is regarding the spud of the KSR 16 well. This is on part of the Circle Oil acquisition, so this is one of the Morocco wells. This is the third of 9 wells in a 9-well drilling program that is due to end back end of 2017. Sorry, and then the last 2 of those 9 wells are actually exploration. So this first 7 that we're on number 3 at the moment, these are development wells, so the existing wells essentially. And in a nutshell, we've had their 3rd quarterly results out recently, and this is a company that is seriously cashed up to the tune of around 30 million US. Net revenues in 2017, 10 million. Net back of 7.5. Actually gaining 4.8 on that acquisition. Now they did a place in September to get 10 million, most of which was spent on due diligence of the Moroccan assets. But that has very quickly turned around into this sort of well workover program, these new spuds that are going on now. And each spud so far has been successful and is being turned on into production within about a month of the actual completion of drilling. So we're on to number 3. We've got a further 4 to go, and the last 2 could potentially be new oil or gas discoveries. And I think what they've also got going on at the moment is they're a very active company, which is nice to see, because you don't often see this on many oil and gas producers or explorers working on a number of different fronts. I think part of the reason for this is they're very well cashed up, but they're making significant profit on high volumes of oil and gas that they're already selling into Egypt specifically. And they're one of the few companies that have actually got around the sort of issue of being paid in Egypt, which I know has been problems for other companies. And I think that's partly due to the success and the networking that the board has done with the Egyptian government. So they've actually got a couple of development wells going on in Egypt, which are going to move forward into the first quarter of 2018. And they've got two more development, exploration wells in Egypt. And they've got a current well workover program at a separate asset. So they've got the Northwest Gemsa asset where the well workovers are going over at the minute, which is to increase existing production. And you've got potential new wells in the South Dazouk area, which will be potentially new production. So this is a company that are probably turning over circa 4,500 barrels of oil per day at the moment, and I think they've got a target for next year to actually double that. So, and they're on course for doing it at the moment. So I think we're at the 50p level at the moment. Personal point of view, I'm surprised that with each of these well successes that they're having at the moment, that it's not rising and continuing to rise. But looking at their chart, Zach, what are your thoughts there? You see that line looks quite healthy.
The message probably was that the shares overstretched them. I mean, they were very over enthusiastic, let's say, in the first half of the year. They're just consolidating now, but consolidating in a positive way. The black line there is the 200-day moving average. So they're finding support there. Technically, if you like the stock, or if you like the stock on a fundamental basis, you'd be looking to buy at the 200-day line. You can see that that's worked in the last few months. Otherwise, you'd probably wait for 55p to break and then go for a momentum trade. But it seems to me that having interviewed the company a few months ago as well, it's just done. It ticks all the boxes of, it's a horrible cliche, but it ticks all the boxes of what you would want to hear and see in a small or in a growth oil and gas play.
Yeah, and I think Paul Welch, the CEO, it's a very widely bandied about sort of objective on AIM, but he is very serious about turning this into a you know, a 9-figure turnover company, and I think that rate up to the 70p mark was when they were spudding one of their main assets in Egypt, and I think a lot of investors were of the hope that they would strike oil when it was initially a gas asset that potentially had oil, and they found the gas that they were looking for in higher volumes than they expected. So I think on a personal level, I guess momentum always does play its part on AIM for sure, but given that you know, I think they actually exceeded their own expectation on that particular drill. The fall in share, I mean, I think maybe it was overdone in the beginning, but I personally feel it's undervalued currently, and I think when we get back into looking at the main assets in Egypt in the first quarter of 2018, that's where the bigger rises will come from. But what they're doing right now in Morocco is very healthy. You know,
I mean, obviously, in the AIM market, you want a company which is a safe pair of hands, and obviously in this area, there aren't that many, and they do tend to disappoint. So this seems to be the best of the bunch at the moment, doesn't it?
Yeah, I think they continue to succeed where others have failed. I think that's the thing. I think when they've taken on the Moroccan assets, people are kind of thinking, oh no, well, you know, Circle Oil haven't done so well, but Circle Oil, you know, financially were quite distressed, and obviously SDX took advantage of that, and that's how the game works essentially. So you know, they've ploughed their resources into making those assets work, and they're proving that almost on a week by week basis as the news continues to come out of this 9-well program. So yeah, I think it's a very good one to watch, but it's, you know, like I say, I'm not a kind of guy who advises people to buy or sell or hold, but you know, you look at it, the third quarter cash figures from last month, they do look very healthy indeed, and they're spending that money wisely. And I think a very good thing to have a look at, again, that not a lot of other companies do, I notice. If you look at their most recent presentation on the SDX Energy website, sdxenergy.com, what you'll find is they'll update this presentation every quarter or so, and you'll always find towards the back end a sort of Gantt chart on the sort of progress they're making on every asset. And they, you know, it's color coded to what they're doing on each well, and it gives you very sort of a quite detailed timeline. So as an investor, you're very well informed as to what the company are doing and when they are doing it. And that may sound really simple, but there's so many companies you just kind of you're reliant on what the next RNS is going to tell you. Whereas with SDX, you've always got a very good idea of what they're doing, when they're doing it, and you know, you've got a good idea of probability of success if you know the story. So I think they're very good at informing the market, and that's what I particularly like about this company.
So investor relations is one of their strong points.
I think so. I mean, they could probably do some more interviews with Share Talk, but
I'm sure
I don't think we've ever interviewed them actually. But so you know, there's obviously no bias from that point of view. But no, I mean,
no, the
yeah,
CEO knows what he's talking about. I do actually remember that interview.
Definitely, so, yeah, definitely. I think with their investor relations on that front, it's more a case of quality over quantity, and I think they've got the balance right, to be honest, being serious about that. So no, it's good one to watch.
Okay. The other news, I don't know if you saw it today, but the open offer at Vast Resources. That's putting you on the spot. But is that good, bad, indifferent?
Yeah. Well, you're entitled to one of the placing shares for every 20 that you've currently got if you're on the shareholder register before the 22nd. Good job I've read this RNS, isn't it, really? But yeah, so I mean, it's I think it offers a good price for existing investors. They still need a further potential $10 million, let's not forget. So, while this money keeps them going and, lets them progress on a couple of fronts, it's not gonna give them the major driver to, get the production really moving. So yeah, it's good, it's necessary. So it's, I think you've got to live with it as an investor, and if you've got spare funds, it's probably, worth carrying on and supporting the company if you're able to, but I wouldn't throw the kitchen sink at it personally. But yeah, I mean, I think the last thing I would want to mention maybe as well, because it's a company we follow very, very, very much in Regency Mines. So RGM, we've not, on a personal level, I don't think it's the best news they've had out this morning, but it's news that a lot of investors have waited for a long time around their coal assets in America. Now it appears that the RNS states that they've been given the option to purchase the asset at Rosa for $250,000, which I have no doubt that RGM have that cash in the bank, whether it's via the YA or via the cash they acquired from the UCOG shares and potential sale of the further Horse Hill shares to Alba Minerals or UCOG, whoever ends up with that last 3.1%. So I don't think the money to buy that coal asset is a problem. The problem to me looks like, from what they're saying, that the books, the accounts of the company they're looking to buy seem to be, I don't think non-existent is the word, but they're not where they should be. So they're obviously, rightly so from an investor's point of view, they're doing a lot of due diligence as to whether that asset is worth purchasing or not. But I don't think that will be welcomed by investors, because investors were hoping to see this in production probably as early as maybe April, May this year. So I think we're in back end of November now. They're being offered a much bigger slice of the pie, so potentially much larger revenues. But if they've got to know that asset's going to work and people are going to buy it, but the infrastructure for the asset is there. I think they just need to work out what liabilities that company have and how that's going to work. I think that's the problem they've got. So they've been upfront to the market this morning in saying what they've said within that RNS. So watch this space on that, but I don't think it's going to perform that great on the back of it. But that may give an opportunity to new entrants. Thoughts, Zach?
Well, no, I mean, it's just it's a bit disappointing given the flurry in the stock earlier in the year. The way that the chart is positioned at the moment, you'd want to see like a break of 0.7, well, the 0.8 really, I suppose, the earlier break of this month, but 200-day average of 0.72. So you're waiting to see whether there's an opportunity to go along here. It does look on the bullish side from this area, so hopefully the fundamentals will tie in quite soon as well.
Yeah, we'll wait and see on that one.
Okay, well, John Adamson from Share Talk. Thank you.
Thank you, Zach. Thank you, Simon.
Have a very good weekend.
Yeah, you too, guys.
Thank you, John. Many thanks indeed. John Adamson, ShareTalk.com. Zach, just time maybe for a look at the FX markets before we.
Yeah. Just here. I mean, I started off with the FTSE here, but a bit of a sharper rebound. It was sort of like a false breakdown that we had yesterday below 73.80. But a clear shoulder, right-hand shoulder there, given the head and shoulders type formation we've got over the course of the week. This is the 15-minute chart. So 74.20 now looks to be the block on progress to the upside for the FTSE. Onto the DAX as well. We had the flip up from the initial morning lows yesterday. Failed at the pivot. That's the blue line there. Today we've got support at the pivot initially, 129.87. So we're bouncing there, but again, a sort of shoulder type block there around 130.50 on the DAX. So the sort of the downward pressure from earlier in the week seems to be reasserting itself towards the end of the week. Onto the currencies, the old pivot method working there on the euro dollar. This is the 15-minute chart. So pivot there at 118.38. Bounced off that in the last hour or so, but resistance coming in there towards 118.60. So we'll see if that breaks. But obviously this has been a relentless rebound, which I think Cal Harmer basically called earlier in the week. Fantastic analysis there from her. Basically long short the dollar, and so that has really played out really well. Consolidation here, and you would probably be betting on this breaking to the upside. And it's normally the case that euro up, DAX down. And finishing off with cable, doesn't want to die, this one. We had the move again from the middle of the week, basically retraced about what sort of half to a third of that, bounced off first support here, 132.80 or so, and it looks as though we're going to break through towards the what is that, 133.50 plus later in the day. So dollar on the back foot, and currencies doing well.
Okay, Zach, thank you very much. That takes us up to almost 10 to 9. I think that's our lot for the week. So thank you for all your contributions. Thank you to Russell Jones this week, John Adamson, and the other guests that we've had on. We'll look forward to seeing you again 8 o'clock Monday morning.
Thank you very much, Simon.